Imagine if you could anticipate the mood of the stock market, predicting its ebbs and flows with a degree of accuracy. Based on the time of year, understanding that certain periods historically favor growth, much like a farmer knows when to plant seeds, aligning their actions with the natural rhythms of the seasons for the best possible harvest. This is the essence of seasonal stock market trends, a concept that suggests the market isn't entirely random. Recurring patterns shaped by human psychology, the collective sentiment of investors that tends to repeat itself year after year, economic cycles, the predictable expansions and contractions that influence market behavior, and calendar events such as earnings seasons and Federal Reserve meetings, which can trigger specific market reactions. Jay Kaeppel's book, Seasonal Stock Market Trends, a valuable resource for understanding these patterns, reveals that certain times of the year have historically been more favorable for investors, offering potential opportunities for strategic positioning. By analyzing decades of data, meticulously examining past market performance, Kaeppel shows that stocks often rise during specific periods, exhibiting bullish behavior, and stagnate or fall during others, experiencing periods of bearish sentiment. For beginners, these trends offer a roadmap, providing a framework for understanding market behavior, helping to make sense of market ups and downs, the inevitable fluctuations that can be unsettling, and reducing anxiety about short-term volatility, allowing for a more rational and less emotional approach to investing. Understanding seasonality can prevent panic selling, the urge to liquidate assets during market downturns, during historically weak periods like a dip in July when market performance tends to be weaker. In this video, we'll break down key patterns, the most prominent and reliable seasonal trends, like sell in May, a well-known strategy based on historical underperformance during the summer months, the Santa Claus rally, the tendency for stocks to rise in the last few trading days of December and the first few of January, and the presidential cycle, the 4-year pattern in stock market returns tied to the US presidential election cycle. Using historical data, providing empirical evidence for these seasonal patterns. More importantly, we'll show how you can use this knowledge, integrating seasonal trends into your investment approach to make smarter, more confident investment decisions, enhancing your overall portfolio performance. The goal isn't to time the market perfectly, a near impossible feat, but to add another layer of understanding to your long-term strategy, enriching your investment toolkit. One of the most powerful seasonal patterns, a recurring theme in the world of finance, is the best 6 months strategy. It's a concept that many investors swear by, and for good reason. Historically, most stock market gains occur a significant portion of the year's overall profits from November through April, the colder months of the year, late autumn, winter, and early spring. This period often sees a surge in market activity and positive returns. Data from the Dow Jones shows, when analyzed over decades, that investing only during these months, focusing your capital during this specific window, and switching to cash or bonds for the rest of the year, adopting a more conservative approach in the off-season would have outperformed staying invested year-round. It's a compelling argument for seasonal investing. This pattern is driven by factors like the confluence of elements that contribute to this seasonal trend. Post-earnings optimism, the positive sentiment following corporate reports, holiday spending, the surge in consumer activity during the festive season, and new investment inflows in January as people start the year with fresh financial goals. For new investors, it's a lesson a valuable insight into market behavior. Market returns aren't evenly spread throughout the year, they tend to cluster in specific periods. While you shouldn't trade in and out based solely on the calendar, relying exclusively on timing the market is risky. Knowing this pattern can help you set realistic expectations and manage your portfolio more effectively. And stay calm during slower periods. Understanding market cycles can reduce anxiety. Embrace the idea that investing is about more than just chasing quick profits. Navigating both fruitful and fallow seasons, it's about long-term growth and strategic adaptation. The flip side is the adage, sell in May and go away. From May to October, markets often deliver weaker or even negative returns, a period known as the summer doldrums. The S&P 500's average return during these months is close to zero, with many years seeing little or no progress. Lower trading volumes, fewer economic catalysts, and investor vacations all contribute to this pattern for beginners. This isn't a strict rule to sell everything in May, but a reminder to expect slower growth and avoid panic during summer dips. Understanding this trend helps you stay patient and focused on the long term, even when your portfolio stagnates. Investing is a marathon, not a sprint. Embrace the slow stretches. Use this knowledge to manage your emotions, not to time the market. The January barometer suggests that the market's performance in January often predicts the year's direction. Since 1950, a positive January for the S&P 500 has led to a positive year over 85% of the time. This pattern is rooted in investor psychology and the influx of new money at the start of the year. A strong January signals optimism and can set a positive tone for months to come. For beginners, treat the January barometer as an interesting indicator, not a reason to overhaul your portfolio after 1 month. Use it to gauge market sentiment and adjust your expectations, not as a crystal ball. Remember, long-term discipline matters more than any single month's result. The Santa Claus rally is a short but reliable pattern. Stocks often rise during the last 5 trading days of December and the first 2 of January. Since the mid-20th century, this 7-day window has produced positive returns nearly 80% of the time. Holiday optimism, bonus-driven investing, and lighter trading volumes all contribute to this effect. For new investors, the Santa Claus rally is more a curiosity than a trading opportunity. It's a reminder that sentiment and the calendar can drive short-term moves. Enjoy the festive boost, but keep your focus on the bigger picture. Beyond the standard yearly calendar, which marks earnings reports and economic data releases, the US presidential election cycle reveals a fascinating 4-year market rhythm that investors should be aware of. Historically, the first 2 years of a president's term are often weaker for stocks as new administrations implement their policies and face potential economic adjustments. While the third and fourth election years are typically much stronger, exhibiting more bullish market behavior. This pattern is largely driven by political motivations. Stimulus and pro-growth policies are often introduced to bolster the economy, often ramp up significantly before elections, aiming to create a positive economic outlook, all in an effort to boost public sentiment and improve the chances of re-election or continued party control. Data shows the third year of a presidential term has historically rarely seen losses in the stock market and often delivers substantial double-digit gains for investors. For investors, understanding this recurring cycle adds valuable context to short-term market moves and helps to set realistic expectation for potential market performance in different years of the presidential term. However, it's crucial not to base your entire investment strategy solely on political cycles. but rather to recognize and understand how the election cycle can potentially influence market returns and investor behavior. Use this knowledge to help you stay patient and informed during potentially choppy or uncertain market periods, and to strategically capitalize on the historically stronger market years within the cycle. The market's overall rhythm and performance is shaped by a multitude of factors, extending beyond just pure economics. It's also significantly political, and understanding this interplay is key for successful investing. Not all sectors follow the same seasonal patterns. Energy stocks often rise in spring and early summer thanks to increased travel and higher fuel demand. Retail stocks shine in autumn and winter, driven by back-to-school and holiday shopping. Understanding sector seasonality helps explain why parts of your portfolio perform differently at different times. For beginners, it's not about constantly rotating sectors, but about gaining context for your investments' ups and downs. If you own home improvement stocks, expect stronger results in spring and summer. Sector seasonality deepens your understanding of the market cycles. Knowing about seasonal trends is only useful if you apply them wisely. Use seasonality as context, not as a strict timing tool. Jumping in and out of the market can backfire. Let seasonal knowledge help you manage expectations and emotions, especially during historically weak periods. Consider dollar cost averaging. Regularly buying more when prices are low and less when they're high. You might invest a bit more during late summer dips, but don't try to time the bottom. Remember, seasonal trends are averages, not guarantees. Unexpected events can override any pattern. Focus on diversification and long-term discipline. Think of seasonality as checking the weather before a journey. It helps you prepare, but you still need a solid plan. Jay Kaeppel's work shows that markets aren't entirely random. There's a rhythm shaped by the calendar, psychology, and cycles. For beginners, this framework makes the market less intimidating and more predictable. Patterns like the best 6 months January barometer and presidential cycle provide a map for the market's journey. The real value is in managing your own behavior. Set realistic expectations, avoid panic, and stay disciplined. Combine seasonal awareness with diversification and regular investing for a robust approach. Remember, these trends are tools, not certainties. They offer probabilities, not promises. Embrace the market seasons to build patience, discipline, and long-term success. By learning the rhythms, you're better equipped to plant, grow, and harvest your financial goals.